Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to required new fund formula. All balance sheet accounts change relative to sales. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 437 Required New Fund Formula. All balance sheet accounts change relative to sales tab in the Practice Problems section. Closing this back out, we're going to read through the information up top, then we'll have a smaller portion of that information we can use to then work through the practice problem. So we have the Required New Fund Formula. This is going to be a formula that we want to learn. We want to be able to plug the numbers into it. And we also want to be able to break it down to its components to understand it better. So we're going to break this formula down into its components. The formula can also be adjusted and varied for different kind of conditions within the company as you use it for its predictive purposes into the future, either in practice or you might see different variants on it in a book type of problem. So let's break this out. We're going to say the sales last year were going to be 110,000. Assets and current liabilities vary directly with the sales. So we're looking balance sheet account, income statement account, sales changing. We're going to say that the assets and liabilities balance sheet accounts vary directly related to the sales. The company is working at full capacity. So if you're thinking about full capacity, we can think about basically the fixed assets, the property, plant, and equipment of the company. And if they were not at full capacity, note that you can imagine a situation then where sales could increase and they wouldn't need any new property, plant, and equipment, right? Because they're not using their property, plant, and equipment currently at the capacity. However, if they're at capacity, we would think the property, plant, and equipment would have to increase if there was an increase in sales volume. So, for example, obviously, if you think about like a restaurant or something like that, if they're working at capacity, the restaurant's packed. And if sales go up, if you want more sales, you're going to need more room. That means the fixed assets, you might have more rent or something else that would need to go up. So that's going to be a assumption we'll make in this problem that we're working at full capacity. Therefore, when we think about sales increasing, we're going to think that we need more fixed assets as well. So then we have the balance sheet. So the balance sheet, we have the cash, accounts receivable, inventory, current assets. Then we have the fixed assets at the 43,000, total assets at the 121,000. Liabilities, accounts payable, accrued wages, accrued taxes, current liabilities at the 40,000, and then the note payable at the 13,000, total liabilities at the 53,000. And then we have equity. We have the common stock, the retained earnings, total equity, and then the liabilities and equity, of course, equaling what's up top in the total assets. So then we have the estimated growth in sales. We're estimating a 25% growth in the second year. So in our projected year going out, 25% growth. How much new funds are needed to finance the growth? So notice if we have a 25% growth, then we got to think about, how much funds are going to be needed in order to fund that type of growth. Also note that we have a dividend payout here of the 55% and a profit margin of the 10%. Okay, so given those assumptions, we're going to go back down. We got a shorter kind of recap of our data here so that we can reference that. This is going to be the formula that we will have, the required new fund formula. In essence, it's going to be assets over the sales for the current year or the prior year, not the forecasted or year two. That's what the 1 stands for. And then multiply times the change in sales. So the sales, subtracting the sales out 1 year minus the other. And then minus the liability portion, liabilities over the sales for the first year, times the change in sales, minus the profit or net income times sales 2, meaning the projected sales into the future, minus 1 minus the dividend, and we're talking here the dividend percent that we will have, the dividend payout ratio. And so let's break this down and kind of compare it then to our normal accounting equation formula here and just see if we can think about this logically, and then we'll start to work it out, and I'll work it out in its components as we think about the 3 components. So this first component here, you can think about this as basically the asset component of our accounting equation, and then the second component, liabilities, and over here, the equity component. Now, when you're thinking about the accounting equation, you can think about it as assets is what the company has, the other side of the coin being liabilities and equity, who has claim to those assets. So if the assets are going to go up, then then we have to think about, well, how is that going to be financed? What kind of financing is happening? Are the liabilities going up and the equity are going up, right? So if the assets increase, what's going to be the change in the liabilities and the equity? So if you think about that over here, you're saying, okay, if the assets increase, they have to be financed either with liabilities or equity, or there may be needing more financing in order to support that increase in the assets. So if the assets increase, assets minus the liabilities minus the equity means new funding is needed, right? If that's a positive number. So if assets are increasing and they're not being, and liabilities and equity are less than the increase in assets, then you would need the required new funds. That's going to be the idea here. All right, so let's break this down more. We're going to say, okay, then we have the total assets that we're going to be saying divide. And notice we're taking total assets because we're assuming kind of the assets, once again, all the assets because they're working at capacity, even the fixed assets are going to change relative to sales. So we'll take the total assets divided by the current year sales times the change in the sales that for the future period. So meaning future period minus the current period. In other words, if we want the sales to be remaining the same, you would think that the assets would be sufficient in order to basically generate the same sales. But if you want the sales to increase, then we're going to take the ratio of the current assets, total assets, over the current sales times the change or the increase in sales of the next time period. And that's going to give us our asset portion, the asset increase. And then we're going to say, okay, liabilities are also going to change relative to sales. So, and you can kind of think that would kind of make sense, right? Because if the liabilities, at least the accounts payable, you would think would kind of change with relation to increase in capacity, and other liabilities may too, as well. You know, other payables could change with capacity as well. So as we increase the sales. So then we're going to say that we have the liabilities over the sales for the current period times, once again, the change in sales. That's going to be increase in the liabilities, which is going to help us to finance part of that increase in the assets. And then we have the equity. Now, the equity, we'll talk more about the formula a little bit as we work out the formula, but just in practical terms, you would say, well, what is equity? The change in equity is going to be the net income. That's going to be the change in equity. So that's going to be the net income for the second time period. And then you're going to subtract out the amount that we're going to pay out in dividends. So that's what this 1 minus D is going to be. So that's what we're basically calculating here. We'll focus that in more on that as we work through the calculation. So the next thing we can do, obviously you can plug this in algebraically, pick up these numbers, plug them in algebraically. I think it's useful to kind of put this into like a tax form type format and look at it in a vertical kind of format. And so that's what we'll do here. We'll calculate it vertically, and we'll look at it component by component, assets, liabilities, and equities. So here it is. We're breaking this information down. We'll start off with the first component, this component here. So assets are going to be the 121. We're picking that up from the balance sheet, of course. The 121 total assets, we're picking up the fixed assets as well, because we're saying the fixed assets will change along with the change in sales because they're at capacity. If they were not at capacity, note we could modify this calculation and not include the fixed assets, but only the current assets, as we may do in a future problem. So then we're going to take the assets over the sales, and notice there is going to be some rounding, I believe, in this problem. So just note that we're going to have rounding involved. So we got the 121,000 divided by the 110,000. That's going to give us 1.1 exactly. So no rounding issue there. And then we're going to say that we have the change in sales, and that means we're going to take the year 2 sales, or the projected sales, minus the year 1 sales. The year 1 sales are going to be that 110,000. Then we said there's going to be a 25% increase in year 2. So if we take that 110,000 times 0.25 plus 110,000, we get the 137.5, or this is just like a tip type of formula. If you're figuring out a tip, you can take the 100% plus the 0.25% times the 110,000. That's going to give us the 137.5. So we got the 137.5 for year 2 minus the year 1, which is going to be the 110,000. And that's going to be, minus the 110,000. That's going to be the 27.5 27.5. If we take that 27.5 times now the 1.1, we're going to get the 30,250. So that's going to be our calculation here. We took this number divided by this number times the change in S, and that's going to give us basically our asset portion. So you're going to say, all right, well, we're going to expect then the assets to increase by the 30,250. How will that be financed? Will it be financed by liability, equity, or are we going to need more financing in order to finance that increase that we expect in the assets in order to accompany this 25% growth that we're having? So then we're going to take the second component, which is here. We're going to take the liabilities over the sales times the change. So we're going to say, all right, and notice we're taking current liabilities here. So we modified it a little bit in that we didn't pick up long-term liabilities. We're going to say the long-term liabilities are not going to change, only the current liabilities, which is probably normally the assumption you might make, right? We're going to say the notes payable is going to be the same. Current liabilities, the 40,000 are going to change, which is what you would kind of expect because if sales go up, you would expect the payables to go up in proportion, right? You would expect accounts payable to go up somewhat proportionally, and then the wages possibly and the taxes as well to go up proportionally to a sales increase. So we're going to say, all right, let's just take the current liabilities and divide that by the sales number. Once again, the 110,000, that's going to give us our 0.36. So we got the 40,000 divided by the 110,000. And notice it's not even right there. So just note that I'm actually going to use this number when we do our calculation, even though it says 0.36 here, because this was done in Excel. And then we're going to say the change in sales, which we already calculated up top, change in sales, 27.5, times the 0.36 now. So I'm going to, which is actually this number. So I'm going to say times the 27.5 is going to give us our 10,000. So that's going to be our increase in the liability. So we're going to say, all right, well, assets are going to go up. Liabilities are going to finance that increase in the assets by 10,000. Is equity going to pick up the rest of it, or are we going to need financing? So we then say the profit margin is going to be 10%. So that's going to be the profit margin that was given up here, the profit margin. And then we have the sales for year 2, which is the 137.5, which we figured here. That's going to be our projected sales. So notice that if I multiply those two out, we're going to say the 137.5 times the profit margin, 0.1, that's our net income. That's what we expect to be our net income. So our projected bottom line of the income statement, which would be the increase in equity, except for the fact that we're going to pay out dividends too. We're going to pay out dividends, and that's where we're going to get this 1 less the dividend percent. Now, let me just think about this, how you'd probably logically think about this if you weren't putting together the formula in the most, shortest kind of way, refined kind of way. You'd probably say, okay, and now I'm thinking about the equity side of things, and I'm going to say the net income is going to go up by this 13,750, and then we're going to pay dividends because we've promised to pay out dividends of the 55%. That's what the dividend payout ratio, that's what that means. So we're going to say, all right, well, that means that of this 13,750, we're going to pay 0.55 in dividends to the owner. And so that's going to be the 7,562 or 63 about. Therefore, the net increase is going to be the net income, 13,750 minus the 7,563, and that's going to be the net increase in equity of 6,188. And so how are we going to do that with a formula? Well, we can refine that down in the formula so that it fits in this nice little formula by saying, okay, we're just going to take the profit margin times the sales, which is the net income, and then multiply it not times the dividends that are going to go out, because then you got to do a subtraction thing here. We're going to multiply it times the dividends that didn't go out, 1 minus the 55, meaning the amount that we kept in income. So we're going to say, okay, the 137.5 times 0.1, that's our net income, times the amount that we're going to keep of that amount, which is 1 minus the amount that we're going to pay out, or 1 minus 55%, or 45%. 0.45, that's going to give us the 6,188 about. So that's going to be our equity side of things. So now we're going to say, all right, we have our assets are going to increase by the 30,250. That needs to be financed either by the liabilities or equity. The liabilities are going to finance 10,000 of it, and the equity after we pay out the dividends of the 7,563 are only going to finance the 6,188 of it. Therefore, we're going to need new funds of 14,063 in order to fund this 25% increase. So you can see how that kind of works, right? If we're funding 25% increase, we're going to say that we're going to need the assets to do that, because we're basically saying that we're going to get a return on the assets. So we're going to need an increase in the assets, including an increase in the fixed assets, because we're at capacity right now. Like the restaurant's full, you're imagining. We need more capacity in order to increase. Therefore, the total assets are included. So that means that we're going to actually need financing in order to fund that increase. So you can see now how you can kind of adjust this formula once you kind of get it down to this and look at it in its components. And one common adjustment might be, well, what if we're not at capacity, right? Then we might not take total assets. We might be taking current assets or something like that. And you could start to modify how the asset and liability accounts will possibly change, or your projections of what they will change in relation to any increase in the projected sales amounts. So I think we'll work at least one more with a little bit of a change, including being not at capacity, and then we'll work through this as if we're not at capacity, and we'll take into account the assets and changing that component from total assets to current assets due to not being at capacity.